Hey everyone, Couch Investor back with the second earnings video of the day. We already covered the Microsoft and Google earnings. If you missed that, it's going to be in the top right corner. Now let's touch on Teladoc, the pandemic darling, a pretty big position in Cathie Wood's ARK Invest portfolio as well. The stock keeps going down. And to be honest, there's really no clear sight as to when this company will become profitable. As for the earnings report, there were a couple of positives, but most of it is really not that exciting. And so my question here is for the ones that are still holding this stock, why do you still hold the stock? What do you think will happen in the coming quarters? Let me know down in the comments below. Now let's have a look at the numbers. So first up, a couple of comments here from the CEO. So our third quarter financial and operating performance reinforces the fundamental strength of our business and our success in making better health available to more than 90 million members. Each day, we partner and innovate with the largest healthcare payers and partner globally to offer unrivaled whole-person care, offering the broadest range of integrated health services available together virtually. Our solid balance sheet enables us to invest in innovation supported by the deepest bench of medical professionals. As we look into 2024, we will continue to advance virtual care in ways large and small. We've seen the positive impact of our unified app, which allows members for the first time to access complex states of care on a single device. We will accelerate our efforts to drive value through improved business performance across the enterprise, undertaking a comprehensive operational review of the business to further improve our efficiency. We are committed to building an even stronger company that continues to deliver on balanced growth while keeping our promises to clients and caring for our members. There is nothing here that says anything about profitability, by the way. Now, I do want to add a couple of things with regards to the healthcare industry and how AI gets in all of that. So this comes from a Morgan Stanley research. So the budgetary allocation to artificial intelligence and machine learning in the healthcare sector is expected to reach 10.5% in 2024, up from 5.5% in 2022. They also say here, citing a recent survey, the bank noted that 94% of healthcare companies employ at least some form of artificial intelligence machine learning, and only 24% of medical devices currently leverage AI and ML technology. Now, if you remember back in July, there was this announcement that Teladoc will partner up with Microsoft with all of their AI capabilities. A lot of people thought, oh, this is the next big step for Teladoc, but this was only for automating some clinical documentations or stuff like that, so really not that groundbreaking. Then we also had the outside pressures, right? The pressures of, for example, Amazon Clinic launching nationwide in the United States. Of course, we have already known about Amazon Clinic for a while, but most recently it was announced that it is available nationwide, putting another pressure point, let's say, on the Teladoc thesis. Could be. There's also the RX Pass here with Amazon Prime, pharmacy, One Medical. I mean, you could understand why people were maybe a bit fearful and maybe still are, and that's why they're ignoring to invest in Teladoc. Could be. So let's have a quick look at the highlights here. Q3 revenue of $660 million, that's up 8% year over year, and comes also in the middle of their own guidance. Net loss per share of 35 cents, adjusted EBITDA of $88.8 million, that increased 73% year over year, which was also good with regards to their guidance. Fiscal year revenue outlook is a bit lower than the previous one on the high end, by the way. Net loss per share outlook, a loss of $1.50 to $1.40. Then as for adjusted EBITDA outlook, $320 to $330 million, which is a little increase from their prior outlook, so that's good, which you can see on this slide right here. Also, US integrated care member for fiscal year 2023 between 89 to 90 million, previous guidance around 86 million. Now, before we jump into the segments number, if you enjoy this type of videos, give it a thumbs up, subscribe if you have not, we really appreciate that. And if you want to support me even further, do check out the link down in the description and in the pinned comment to get the top 10 best stocks to buy now, or go to fool.com/couchinvestor. Thank you very much. So, revenue, adjusted EBITDA, we've seen that. Revenue, yes, there is a small increase here. Adjusted EBITDA, an even bigger increase, but segments results. BetterHelp segment revenue decreased quarter over quarter. Not really the thing you want to see. And the same thing here with adjusted EBITDA. It wasn't really stable before, but now we went from 34 million to now 26 million. Not great with regards to integrated care segment adjusted EBITDA. A big increase there, but BetterHelp was previously really a big positive for this business. Right now, maybe it's just a 1 quarter thing, could be, but this is not that great. As for US revenue and international one, international still sits at $91 million, which is basically flat quarter over quarter. US revenue is a bit up quarter over quarter. As for the quarterly key operating metrics, BetterHelp paying users, it's down quarter over quarter, obviously explaining what we've just seen before. Chronic care saw another little increase quarter over quarter. With regards to US integrated care members, we're now at 90.2 million. Average revenue per month per US integrated care member, basically flat quarter over quarter and flat year over year as well. But here comes a slide with a bit more positivity, let's say. Margins have actually increased quarter over quarter. Adjusted and GAAP gross margin are up quarter over quarter. Fine. Good, we'll give them that. Adjusted EBITDA margin also increased here quarter over quarter. So adjusted EBITDA from 72.2 million to 88.8 million. And then the margin went from 11.1% to 13.4%. We'll take that. As for the balance sheet, cash and cash equivalents of just over $1 billion. Last quarter was just under $1 billion. So, okay, good here. Operating cash flow, $105.6 million. So that's fine. Then with regards to stock-based compensation, last quarter Q2 we saw an increase again quarter over quarter, which was not that great because it broke the trend of always coming down. But Q3 has come down yet again. We went from 55.7 million to 52.9 million. Now looking at the graph here, of course, for a while there was this base forming at around $23, $24 or so. We were trading in the range between that $23 to $32 or so for quite a while actually. But then back at the end of August, we broke down and went down. We're now trading under $18, which if we go back in time, the last time it traded at $17.19 was around January 2017. And of course, rest assured, back in January 2017, the margins were probably worse than today. Revenue was much lower than today. The amount of members was much lower than it is today. So yes, historically speaking, you are going to buy a company that is much better today than it was in 2017. But probably in 2017, people were expecting it to be much better positioned in 2023, especially when we talk about profitability. So yes, if we do compare the stock today in the next 12 months compared to its 5-year mean, yes, EV to EBITDA, price to sales, price to free cash flow, it is much cheaper than before. That said, the promise of it ever being profitable, how much longer will investors have to wait to see some profitability here? Remains to be seen. So that will be it for this video. Of course, if you are a Teladoc holder, do share your thoughts down in the comments below. And if you enjoy this type of videos, leave it a thumbs up, subscribe if you have not. I'll see you all in the next one. Bye bye.